Hello, trader. Trading without a strategy is gambling, and having a strategy without rules is like having a crossing without traffic light. So, to have a strategy with proper rules is very important to be profitable over the long term. So, in this video, I'm gonna discuss the most three important rules of a profitable trading strategy. By watching this video, you will be able to know what are these three rules that a profitable trading strategy should have, and then you can match with your own strategy. Either you are having that or you can integrate those rules in your trading strategy. So I'm going to show you step by step what are these three rules, and I'm going to show you in the real chart how you can apply those rules in your own strategy. So before I begin this very important educational video, give a big thumbs up and also subscribe to the channel if you haven't done yet. This is Forex Wizard from Forex Trading Wizard Academy. So without further delay, let's get started with the first rule of a profitable trading strategy. Now, the first rule that I consider is the consideration of trend. Now, they said that trend is your friend until it bends in the end. What I would say that trend is your friend for the rest of your life as long as you are trading, because trend trading is the most profitable trading system. Those who trade with the trend and hold the trade for bigger profit with a proper risk management, with right trading psychology, that definitely become a consistently profitable trader. So this is very very important that one must follow the trend when you are trading. So how do you keep the trend in your trading strategy or in the rules of your trading strategy? Let me show you a real chart example to know how to consider trend in the strategy. Now let's see this chart. Now what do you see that in this market? The market is starting from here, created this impulse correction, impulse, deeper correction, consolidation, and then has broken the market structure, created a pullback, and started another direction. Now, how do you read this market? If we separate this, what do you see that in that area the market is creating series of higher high and higher low, which is an uptrending market structure. A market when creates series of higher high and higher low, it is in an uptrend. But when the market fail to create a new higher high, instead we saw that created a lower high and broken that market structure, means that this trend has changed from an uptrend to a downtrend. And we saw that after changing from uptrend to a downtrend, the market started to create a lower high and lower low. Now, how do we integrate this trending direction in our strategy? The first of all, to integrate the trend in the trading strategy, the first thing that one must know, when is the start of an uptrend, when is the start of a downtrend, and when is the end of a trend. Now, the best way to know that is to identify where is the smart money area. For example, when this market is trending, creating series of higher high and higher low, there is a point where we can identify the neckline of this reversal. This is a reversal pattern as the price has consolidated in that area, and then the price has broken that neckline and has broken that neckline completely towards the downside. And once we identify this neckline, this support, which turned here as a resistance, and we saw that the price has broken that level, tested this zone, and then has again immediately broken to the downside. Now this is the smart money zone. Now, understanding this zone, we know that this is where a market changes its uptrend to a downtrend. And when we identify this level, any trade will open below this level will be only looking for selling opportunity. So any strategy that I will be using in this zone, I will look for selling opportunity. This is one way to identify. There is another way. There are many ways you can identify the direction of the trend. For example, in my chart, you can see 10 and 20 EMA also giving a direction of the trend, the way they are separating from each other, giving me a direction of the trend, which is an additional confirmation for the direction of the trend. So this is how we can integrate the consideration of trend to know that there is an uptrend or in a downtrend, and based on the direction of the trend, we can look for either buy or sell. Very simple. Now let's look at the second rule that I consider the most important, one of the most important rules of a profitable trading strategy is considering or consideration of liquidity. Now, liquidity is the fuel of the market. As you know, the market moves from liquidity to liquidity. Why liquidity is so important is because when you see that liquidity is triggered or the market grab liquidity, that means that big boys bought or sold a big lot from that area. As the market moved by big boys, once we know the liquidity, we know that big boys is trading this market. Big boys means the hedge funds, the institutional trader, banks. When we know their zone where they are buying or selling as a retail trader, we can follow their footstep to take the bigger move in the market. Now, if you look at this, the same chart, where is the liquidity? Let's identify those candles which has a liquidity, and I'm going to put some circles so that you know exactly where is the market is grabbing liquidity, and you know exactly where you can see these candles that in fact are the most important trading zone where the big boys bought. Now the circle that I put in this chart, this is where the big boys bought or sold in the market. Now you can see that in that zone, a retail trader might wish to buy or sell in from many areas. But if you look at those zones that I have marked, is where the liquidity trigger. And as you can see, buying or selling from those zone are incredibly profitable. So it is very important that one must know where is the liquidity in the market. And what is liquidity? As I mentioned, is the volume in the market where huge volume comes in the market. Now, if I give you an example, let's say when we are selling from this zone, we are a seller, but our stop loss in that zone is a buy order. And once a price grab liquidity means that it has triggered a lot of stop loss in the market, and as the seller's stop loss is a buy order, and big boys then sold from that zone, and from that buy order they bought and big boys sold, and this is where we see that the market in fact makes bigger moves. And as a retail trader, it is very important that we can identify those zones so that we can take bigger trades to take the bigger moves in the market. Now, the third rules that I consider the most important, one of the most important trading rules is entry and exit criteria. Now, it is once we know that direction of the trend, and we know the liquidity zone, we know that what to do, either to buy or sell in the market. The next thing is when to enter. And when to enter comes from the place of entry and exit correct criteria. Now, every trading strategy have its own entry and exit criteria. For example, an entry or criteria could be seeing a pin bar on a specific zone or a bullish or bearish engulfer in a specific zone. If I give you an example, let's assume that your entry criteria is to see a bearish engulfer in a very, very important previous resistance, previous support from resistance. If I consider this one here, this is a very important previous support zone here. If you look at back, you see this is the support here. If you extend this line, what we see that this is in fact significant level of resistance here, support here, which is turning resistance here. And from that level, if we see, for example, a bearish engulfer, we can sell this market. Now, this is just one example. There could be many other examples in combination with indicators, in combination with price action, market structure, and liquidity. So this is an entry. It could be an entry criteria, and there are many other ways also we can set exit criteria. Now, exit criteria could be that you want to exit your trade after you gain three times profit mathematically, regardless of levels. It could be two times profit, it could be five times profit than your risk. This could be one of many exit criteria, or you could set your exit criteria based on level. For example, you trail your stop loss, and it could be that you will keep moving with the trend and trailing your entry or trailing your trade till as long as it wants to go. And this could be another exit criteria, that until it comes back and take you out of the trade, you keep moving with the trend. Or it could be, let's say, your exit criteria could be an important key level that you want to exit, because afterwards you may consider that the price might be reversing. So these are the most important three trading rules that I consider in my trading strategy. Now, this varies based on the strategy to strategy. Now, if you want to know more about our strategy, where we do have a rule based trading strategy, not only these three rules, in addition to that, we use indicator and some other important factors that give us a clear signal in our trade in Forex Trading Wizard Academy. Also, you can join us to learn one of the most important and best trading strategy you'll ever find there. You can join us. There is a link in the description area. You can visit the website and also let us know any question that you have. With that said, guys, thank you very much. I hope that you enjoyed this video. And any question, let me know. I will get back to you straight away using the comment section. Thank you, and I will see you soon.